Welcome to Debt Matters. If you've been keeping an eye on the financial headlines, you've probably seen one number from the Bank of England that seems uh, pretty determined to stay put, 3.75%.
It creates a sense of stasis, doesn't it? Like the entire economy is just sort of holding its breath.
Exactly. And the expectation is that they are maintaining the bank rate at that 3.75% level.
hmm
Now, on the surface, no change sounds like a bit of a non-event. It sounds like we can all just carry on as normal.
Business as usual.
But we're looking at this today because that holding pattern is a very distinct signal. It has immediate practical consequences for anyone who's, well, currently chasing an invoice or trying to manage a ledger.
Stasis isn't neutral, not in this world. In the world of credit control, holding the line actually increases the pressure. It isn't just about the percentage point itself, it is about the stance. It's that wait-and-see approach.
So our mission is to translate that headline. We need to take this 3.75% hold and turn it into a practical strategy for credit control and for debt recovery.
Yep.
We're going to look at why the rates are holding, what that signals to the people who owe you money, and maybe most importantly, the specific moves your credit team should be making right now to protect cash flow.
We have to move from the macro news to the micro behavior. How does a decision made in a committee room in London actually change the way a debtor answers the phone in Manchester? That's what we're unpacking.
Okay, so let's start with the big picture, the numbers. The rate holds at 3.75% for the February meeting.
Yeah.
But looking at the market data, the thing that stands out isn't the rate itself, but the timeline for what happens next.
The timeline is the real story here. I mean, if you look back just a few months, there was a lot of hope, a lot of chatter that cuts were imminent.
Right, that relief was just around the corner.
Exactly. But the markets are now pricing in the next cut, not happening until the second quarter of 2026.
2026. That is a long, long time to wait if
Yeah.
you're a business relying on, cheaper borrowing to smooth out your cash flow.
It is a much longer timeline than many people were hoping for sure. And to understand why, you have to look at the inflation context. December inflation came in at 3.4%.
And the bank's target is 2%.
The target is 2%.
So we're close, but not close enough.
We are not close enough. And that gap, that 1.4%, is proving to be quite stubborn. You see, policymakers, they need concrete proof that inflation is genuinely returning to target, and more importantly, that it's going to stay there.
They're not going to move based on a hunch or a single good month of data.
Not a chance. They are watching very specific metrics, things like pay growth and the overall tightness of the labor market.
They need to see the heat come out of the labor market before they even think about loosening the grip on rates.
Correct. And if we connect the dots here, this very cautious approach, it creates an environment where borrowing costs are going to stay elevated for longer.
Which directly impacts business cash flows.
Directly and immediately.
So let's talk about that impact on B2B payments. Because when borrowing is expensive for a business, when their overdraft costs a fortune and new loans are hard to get, they have to find money somewhere else.
And this brings us right to the first major consequence, this concept of survival spend.
Okay.
When rates are high, bank borrowing is painful. It costs a lot. So businesses naturally look for the cheapest form of finance available to them, and you know what that usually is.
They're suppliers.
They're suppliers.
Because if I don't pay you for 60 days, or maybe even 90 days, I've effectively given myself a 0% loan for 2 or 3 months.
That is the mechanic in a nutshell. Debtors start prioritizing this survival spend over their trade credit. They'll pay the electricity bill because otherwise the lights will go off.
Of course.
They'll pay the wages because if they don't, the staff will leave.
Mm-hmm.
But that supplier invoice,
That can wait.
that can wait. It becomes the path of least resistance.
So suppliers essentially become the bank, the lender of last resort.
An involuntary bank that doesn't charge interest, usually. Suppliers get stretched thin because their customers are holding on to cash, either to service their own expensive debt or just to keep a buffer in their account for safety.
And imagine this leads to the second consequence we're seeing, which is the rise in disputes. But we're not necessarily talking about genuine, you sent the wrong item disputes, are we?
Not always, no. There's a really clear link between tight margins and the sheer volume of queries and disputes. When cash is tight, customers become much, much more likely to challenge an invoice.
How did that play out?
Well, they might delay approvals. They might hold back retention payments on a big project.
So they aren't disputing it because the work is genuinely wrong. They're disputing it to buy themselves more time.
It's a tactic. It's a tactic to preserve their working capital. If I can find one tiny error on a 100,000-pound invoice, or maybe just claim I didn't receive the backup paperwork.
You can kick the whole payment into the next month's payment run.
Exactly. It's a defensive behavior born out of financial pressure.
And that must create a terrible chain reaction.
We call that the lengthening of payment chains. It's the psychological effect of this no cut yet message from the Bank of England. Everyone hears rates are staying high, and so everyone tightens their grip on their wallet.
That's a domino effect.
It is. The pressure cascades down. If the big construction firm at the top of the project slows down payments to its main contractor,
Then the main contractor slows down payments to the subcontractors.
and the subcontractors are slow to pay the materials suppliers, the plant hire companies, it just goes on and on.
Particularly in sectors where margins are already paper thin. You mentioned construction.
Construction, absolutely. Retail, logistics, hospitality, all very vulnerable to this.
There's another concept here that feels really vital to grasp, which is something called the lag effect.
This is crucial. It's so important for people to understand this. Even if, let's say, inflation does cool down and gets close to that 2% target in the spring.
Which would be great news.
It would be great news on paper. But cash behavior lags behind the headlines. The economy might look better in the official statistics, but the business bank accounts won't feel that improvement for months.
So we are currently in the gap, the most painful part.
We are in the gap where the pressure is highest. Credit tightens now, but the payment performance won't actually improve until much, much later. We're in that danger zone.
We'll talk a little bit about the messaging from the Bank of England, because the words they use, the tone they adopt, that seems to matter almost as much as the rate itself.
Oh, the tone analysis is key. If the official signal is a gradual downward path for rates, that sounds reassuring, right?
It does. It sounds like there's a plan.
But then, if in the next breath, the next steps are described as a close call, businesses hear something very different. They won't bank on quick relief.
Close call implies risk. It implies things could just as easily go the other way.
And risk makes people conservative. It makes them hold on to their cash. And that translates directly into what your collection teams are hearing on the phone every single day.
Slower payments.
Slower payments, more broken promises, and the absolute classic, we'll definitely pay you next month. Those deferrals just get pushed further and further out.
Okay, so we've set the scene. We have the context. Rates are holding, cash is tight, debtors are getting creative, and suppliers are being used to fund their operations.
That's the landscape.
Let's pivot to the strategy. What do we do about it? We've put together a debt collection playbook with 6 specific tactical moves for this exact environment.
These are practical adjustments you can make to your process tomorrow.
Okay, move number 1, tighten terms on new orders. This is all about preventing what you call drift.
Drift is so dangerous. It's insidious. If a customer is officially on 45-day terms, you cannot allow them to quietly slide to 75 or 90 days. In this environment, you have to stop that slide immediately.
How do you do that in practice? I mean, without damaging the relationship with a good customer.
You use the tools you have at your disposal. You can use pro forma invoices for new orders until they get back on track.
So they pay up front.
They pay upfront. Or you can agree to staged payments on a larger project. Or, in more serious cases, you might have to temporarily reduce their credit line until their payment cadence improves. You have to send a clear signal that the drift is not acceptable.
Right. It's about resetting the expectation.
Precisely.
Okay. Move number 2, accelerate the timeline. The advice here is day 7, not day 30. That sounds like a big shift.
It is, but it's necessary. In a rates on hold environment, waiting for the end of the month is far too late. You're already at the back of a queue by then. You need a new specific schedule.
Walk me through it.
Day 1, the invoice is sent. You get automated confirmation that it was delivered.
Simple enough. Day 3.
Day 3 is a quick call or email to verify receipt and approval. You're not chasing for payment. You're just making sure there are no hurdles. Hi, just checking you received invoice 123 and that it's all correct for processing.
So you're preempting any of those "we never got it" excuses.
You are. And then day 7, this is the key day.
What happens on day 7?
Day 7 is where you secure a commitment, a specific date and a specific amount, not will pay at the end of the month. You want to hear it will be paid on the 25th via BACS. If you don't have that firm commitment by day 7, you are already behind.
And if you get to day 14 with no commitment?
You escalate. That's when it goes to their financial director. Maybe a credit hold is placed on the account. A formal letter is sent. The urgency has to shift forward dramatically.
That makes a lot of sense.
Okay.
Move number 3, make disputes binary. I like the sound of this. It's about combating that blanket delay tactic we talked about.
It is the old excuse of, oh, the whole invoices inquiry just can't be allowed to fly anymore.
So what's the new rule?
The new requirement is this. If a debtor claims there's a dispute, they must immediately provide the exact line item they're disputing, the evidence or reason for it, and agree to a deadline to resolve that specific point.
And the golden rule here is?
The golden rule is that the undisputed amount must be paid immediately on its original due date. Do not let a 100-pound error on one line hold up a 50,000-pound payment.
You separate the problem from the main payment.
You make it binary, yes or no. This part is correct, so it gets paid. This small part is in query, so we'll sort that out separately.
Move number 4 is a bit more serious. Preempting insolvency risk. What are the warning signs we should be looking for?
You need to be vigilant. Look for a combination of these signals. 2 or more should trigger an immediate action.
Okay, what are they?
First, part payments suddenly replacing full payments. Second, a customer who is always responsive suddenly goes silent. No reply to emails, not answering the phone.
Red flags.
Big red flags. Third, repeated requests to reissue invoices for flimsy reasons. That's a classic stalling tactic. Also, more frequent and desperate-sounding explanations about their own cash flow gaps.
We're just waiting on a big payment to land ourselves.
That old chestnut. And finally, keep an eye on official records. Any sudden changes in director details or trading names can be a warning sign.
And the action. If you see a couple of these signs,
You shorten all timelines. You escalate immediately. The priority is no longer just getting paid, it's getting paid before something worse happens.
right. Move number 5. Utilizing cost of delay language. This is about refining the conversation script your team uses.
It's about being firm, fair, and clear. You need to move away from open-ended requests.
So what's a phrase you'd recommend?
Something like this. Look, we understand you have pressures and we can agree a firm payment plan. But what we can't do is extend credit indefinitely. We need you to confirm the exact payment date today. Otherwise, we will have to escalate this to the next stage.
It's polite, but it's non-negotiable. It creates a consequence for inaction.
Exactly. It explains that delay has a cost and that the process will move forward. That firmness is absolutely necessary when rates are static and everyone is feeling the squeeze.
Okay, and finally, move number 6, segmenting the ledger.
This is about focus. You can't treat every debt the same. You need a simple visual system. I always recommend a traffic light system for immediate implementation.
Red, amber, green. How do you define them in this context?
Simple. Red is any account that's overdue by 60 days or more with no active, concrete payment plan in place. These are your highest risk.
Amber.
Amber would be accounts overdue 30 to 60 days or accounts where promises are starting to slip. They said they'd pay last week and they didn't.
And green.
Green is accounts that are current or only slightly overdue, but maybe they're showing early signs of that drift we talked about. They're paying on day 40 instead of day 30.
And the goal of this system?
The specific measurable goal for your team becomes reduce the number and value of the reds and do everything you can to prevent the ambers from turning into reds. It gives everyone a clear focus.
So to wrap all this up, the 3.75% hold isn't just a headline. It's macro news that turns directly into micro behavior.
It does. It means slower payments, more inventive disputes, and longer, more fragile payment chains.
Your advice, then, is to treat this period, maybe treat February, as a discipline month.
Absolutely. A discipline month. Go back to basics. Tighten your terms, chase earlier and smarter, and make sure every single payment plan is evidence-led and not just based on hope.
So the key takeaway is that while we all wait for the wider economy to shift, the control of your own ledger, that remains firmly in your hands.
It always does. You have more control than you think.
Thanks for listening to Debt Matters.
Thank you.
We'll see you next time.